What if you could have an investment that would guarantee your principal, pay you more than what you're getting at your bank with the potential to make as much as the stock market makes, and oh, by the way, you've got 100% liquidity, meaning you can cash it out anytime you want. Does that even exist? Is that too good to be true? I used to be a skeptic, but guess what? There is such a thing, and we're going to talk about what this is today because this might be the best investment that you've ever heard of. What's going on, y'all? Welcome back to the channel, Wealth Hacker Labs. And as you can see, I've got the wealth board behind me, and we are talking about what could possibly be the best investment ever. Is it the best investment ever? We're gonna find that out. Now, you have to remember that anytime you hear something that's too good to be true, then it probably is. So yeah, we're gonna talk about some of the finer points of this investment, but with any pro, there are also cons. So we're gonna look at both sides today. So how did this come to be? So this was working with a client. This was a multimillionaire. They just had inherited a good chunk of money, but they weren't sure if they had to pay taxes next year. So the requirement that they came to me is, Jeff, we want to give you this large sum of money, and we want to make more than what our bank is paying us. We want to make sure that our principal is guaranteed, and we also want access to that money. So we want liquidity. And let me tell you, I've heard that a lot of times as a financial advisor throughout my career. Everybody wants that. They want that risk-free return where I can put my money in, I can make 20% interest, and I'll never lose a penny. And you know, that doesn't really exist. What we're going to talk about today is probably the closest that you can get to that. But you know, when you hear that, you just don't know how the market works. But that's okay. That's why you're here. That's why you're here on the channel. And actually, while you're here, why don't you go ahead and like this video if it's going to provide some content, and also subscribe because we want to get the Wealth Hacker Nation out to all. So go ahead and take care of that right now. So this was the requirement that my clients came to me. They've got over $1 million. They want access to the money. They want their principal guaranteed, and they want to make sure that they're making more than what they could get at their local bank. Okay, that's it, huh? That's all you want? But so I started calling around. I started doing some research, and that's where I was introduced to what is called an IUL policy. So what does ILU stand for? It stands for Indexed Universal Life, Indexed Universal Life Insurance Policy. Now, you have to keep in mind that in my career as a financial planner, financial advisor, I ran into so many insurance agents that were selling whole life insurance, variable universal life insurance, index universal life insurance, and they always would start, this was the first thing that they would lead in with. So if you had student loan debt, if you weren't investing to a Roth IRA, if you weren't putting money into your 401k, that didn't matter. You needed to buy some sort of insurance policy because it's the greatest investment ever. And there are, as you'll see, there are situations where it can make sense, but a lot of the times that I ran into, it didn't make sense. So when the IUL policy was proposed as an option for my clients, I was a huge skeptic. But once again, as I started to learn how this policy works and I understood all the pros and all the cons, then I recognized, hey, this actually could work. So let's go ahead and start with the pros, which we already talked about a little bit. So the first pro that we had is we've got protection. So we've got our principal protection. We want to make sure that we put money in and we're not going to lose anything. That's why many people put their money in banks. They want that FDIC insurance. We don't have that with insurance policies, but we'll talk about what you can look for. So the other pro to this is that you have liquidity. And liquidity is just a fancy word of saying, can I get access to my money? Can I get my money? If I want my money tomorrow, can I get my money? That's what liquidity is. The other pro that this offered was greater return. So this is what it offered. Now the question is okay, well, how is it offering this? What does this really mean? So with protection, once again, life insurance policies don't have FDIC insurance. They are only insured by the insurance company. So what you want to look for is, what is their insurance rating? So this is where you can look at companies like Moody's, Fitch, and all these companies do, all they basically do is give a report card rating on how financially strong that insurance company is. So if you're taking out an insurance policy and they're going to pay you some phenomenal rate, well, if their report card rating, if their insurance rating is like a C minus, I'm not sure how much I'm going to trust that my money is going to get paid back to me in case I need it. So that's one thing you want to look at. The other thing is with liquidity. We'll get to that one here in a minute. And the other part is return, greater return than what the banks are paying. You know, the Fed continues to keep rates really, really low. So what we were looking here was we had the option of getting paid a dividend. And also it had market linked return, which we'll talk about more here in a second. So that's what this policy offered. Principal protection, liquidity, and the greater return than what they were getting at their bank. Now with all of this, there are cons. So we're looking at some of the pros, some of the how like this works. So what are some of the cons when it comes to these points over here? Well, protection. You know, if we want to make sure that our principal is protected, we talked about the ratings of those companies. And that's one of the biggest cons. Like, what is the insurance company's rating? We talked about liquidity. This is also a big one. So with these insurance policies, the IRS is caught on to this, and they know that the rich, the ultra rich, can and will take advantage of every single loophole that they can. So with these policies, you can't just dump a big chunk of money in there. You have to put enough in there that makes sense for how much you have in your savings, how much you have in investments, how old you are, and what is the right amount of life insurance that you need. Otherwise, it will trigger what's called a MEC, which stands for Modified Endowment Contract. So basically all this says is that if you put too much money in, then instead of getting some of the pros of the taxable, tax-free loan nature that these offer, which we'll talk about here in a second, you'll have to pay ordinary income tax, which basically just means that you have to treat it as income. So if you are in a 35% bracket, if you take money out, you got to pay 35% tax. The other pro that I forgot to talk about here, but with having this, if you hold it for a period of time, you can take basically what's called a loan or a tax-free withdrawal. So that's why when you hear these policies talked about, they'll talk about like a Roth IRA alternative because you get all of that. Now, the other con that we have to mention, which kind of plays into this, we talked about the modified endowment contract. So once again, that is just saying that, you know, if you're 40 years old and you are trying to stick a big chunk of money in there and you say, well, I need $25 million of life insurance. And the IRS, you know, they look at your financials, they look at your net worth statement, your assets, your liabilities, all that good stuff. And they're like, wait a second, why do you need $25 million? Like, no, this is all that you really need. So, you know, they will catch on to that. So the other issue here is that it is it's a life insurance contract. So you've got the cost of insurance on top of getting approved. So this isn't a, hey, I'm going to fill out this form, this online form, I'm going to send it off, and then boom, I'm going to get it automatically approved. Like, this is a life insurance policy. So you have to go through the medical exam. You got to go through all your, you know, they request blood work. They'll, if there's any conditions, they'll need to get some notes from your doctor to find out what's going on. Does that mean that you won't get approved? Not necessarily, but it will mean that whatever the benefit is that you get approved for, it might just be less for the amount that you're going to put in. Okay, let's talk a little bit how you actually make money on this type of policy. Like, what was the attraction? Going back to greater return than what the bank is paying. So with this particular policy, there was two different ways that you could make money. The first way was the dividend payment that the policy had. The other way was the market linked return. So let's first talk about the dividend. So, and you probably have heard this with a whole life policy where you take out the policy and especially the insurance agents will boast, say, oh, our company is paying a 5.5% dividend and that's how much we pay into our policies. And when I hear that, like that may very well be true, but once again, there's also the cost of the insurance that they just fail to mention or feel like that you needs to be brought up. So it's been a while since this took out this policy, but at the time it was paying, I think it was around 2.2%. So if you're looking at savings accounts now, I mean, I know that right now you got online banks that will pay close to that, but back at this time, like there wasn't really anything paying more than 1. So at that time when interest rates were really, really low, it was paying 2.2%. That sounds pretty good, but once again, we have to talk about the cost of insurance. So the cost on this policy, if I recall, was about 5%. So the net return was about 0.7. Is that a lot? Well, not really, but it was more than what they were getting at the bank, and that was one of their requirements. Now, the other thing that this offered, and you hear a lot about this in any type of indexed investment, indexed universal life, indexed variable annuities, you'll have what's called the market linked return. And advisors, they can misrepresent this in all different ways. But basically, what the insurance company is trying to do is tie some sort of investment that is linked to another investment that people are more familiar with. Typically, that's the S&P 500, the most common investment that people know. So in this case with this policy, it had a market linked return, so it was tied to the S&P 500. And basically what this policy would say, it would look at the policy year after year after year. So the anniversary date of when you took the policy out is when it would look and see which one of these paid more. So for example, if they put $1 million in and after a year has passed, has the S&P made more or has the 2.2% dividend payment minus the cost paid more? So which one of these paid more? Whichever one paid more, then that's what would get locked in, and that would be your starting point for the next year. Now let's look at it from a different point of view. If the S&P 500 were to go down that first year, then your principal is guaranteed. What you're getting is the difference between the dividend and whatever the cost of life insurance is. Like that's where the win-win is. Now, what really worked out well for my clients is they took this out. This is, I think, somewhere between the 2011, 2014 timeframe. And if you look at any sort of investment chart, like you see that the market has been good. So in that first year, I don't remember exactly, but I want to say they made anywhere from 7 to 8% in that first year. Did something like that in the second year, and obviously it's worked out really well ever since. So it made a lot more than what the bank was paying. Like it wasn't even close. Now, the thing that you have to be careful on, and going back to this whole MEC thing, is if we cash this out too soon. So if you do cash it out, if there are any gains that you have, then that is where typically you're going to have to pay ordinary income. Like it's still not a bad thing. Like you're paying taxes on money that you made. Like that's not a bad thing. Obviously, if you can minimize that, it's so much better. So that's why holding the contract, holding that and just taking those tax-free loans, tax-free withdrawals from the investment make a whole lot of sense. The one final thing that I want to leave you with, the one thing that I want to say that you need to be aware of, put some stars behind that one, are shady financial advisors that are trying to sell this. Now, you'll probably notice that I have not mentioned any sort of insurance company during this video, and there is a reason for that, because if I did, then chances are that insurance company would be contacting me and probably issuing some sort of cease and desist for misrepresenting them. Like, that does happen. That's why I'm not going there. But what I will say is that when I was looking at this policy for my clients, I went to two different places that were offering different types of insurance products for potential investors. And in that process, I learned that they both had the exact same company, exact same insurance company. They both had the exact same investment product. But the way that they ran the illustrations, the way that they ran, which is basically like the sales proposal, one was a lot more beneficial for the client, while the other was a lot more beneficial to me and how much I get paid. Because the more I get paid, the more that they would get a cut of that. And with these policies, they can be structured in so many different ways, so that some they can structure it better for their client, others they can benefit it or structure it where it's better for the advisor and helping out with their checking accounts, just paying them a much larger commission. So you want to beware of shady financial advisors that are just trying to sell you something that just is too good to be true. Now, I know all of this sounded like that at the beginning, but as you can see, there are pros and cons to each. And if you're not 100% confident that what they're saying is true, then get it in writing. If they won't offer it in writing, then I would probably go to somewhere else. Also have somebody else take a look at it. And for God's sake, if you haven't done this, if you're working with an advisor and you've never done this, do a background check on them. You can go online, do a Google search, or you can go to sec.gov, you can go to finrabrokercheck.org, and you can find out if there have been any complaints filed against that advisor. If there have been, then I don't think I'd be investing with them. But as you can see, there is something that does exist that offers principal protection, offers greater return than what you get at your bank, and also liquidity. Just got to work out some of the details and see if it makes sense for you. Hope you enjoyed this video. If you did, be sure to like, subscribe, share it with anybody that needs to know what else is out there, because when it comes to hacking your wealth, you got to get the information. You got to find out what's out there, what all the options are. This could make sense for you. It could not. Either way, you're more educated, and more education equals more wealth and buying power. Until next time, y'all, take care. Peace.